Welcome to The Investing Show, where we discuss the news that matters to investors and get ideas to help you make more of your money. I'm Simon Lambert of This Is Money. Joining me in the studio, I've got Justin Urquhart Stewart of Seven Investment Management.
Hello.
Justin. And Richard Hunter of Wilson King Investment Management.
Simon, Justin.
Now, Justin, there's an old investment saying that there won't be many investors who haven't heard. By a certain Mr. Warren Buffett.
Yes.
There won't be many investors who haven't heard of.
Yep.
Be fearful when others are greedy, and be greedy when others are fearful. Now, the only problem for investors at the moment is, I think, trying to work out whether we're greedy or fearful. We see huge valuations put on certain tech companies over in the States. We see markets hitting record highs. So you might think, oh, that's the sign that we're being greedy. But then there's also this air of pessimism that continues to pervade. Government bonds are trading at record low yields, which obviously low interest rates have something to do with, but that's again a hint of being fearful. So how do we work out? Are we greedy? Are we fearful?
And add to that, you look at the global economy, it's not doing badly. Makes for a rotten headline, global economy doing quite well. But, you know, that again is supporting it. So the thing that I think that people are feeling greedier is because everything's going so well, people like to join in once they know it's heading in that direction. And by the time they start joining in, that's normally the time you should be getting out. And the art is this. First of all, you know, if you're a long-term investor, don't panic, don't worry. You're going to look straight the way through this because you're looking at 5, 10, 15 years, unless you think the world's going to come to an end. If it's going to come to an end, it doesn't matter anyway. So long-term investors, I wouldn't worry too much. If you're looking about trying to enter the market now, then now is not the time to go in with everything right at the moment because no one can time the market. It doesn't feel right at the moment. There's an awful lot of overvaluation going on, but equally there are lots of reasons why it's doing quite well. My concern is what we saw last year when the oil price had come down, nearly 2 years ago now, it takes about a year, 18 months to come through to affect the global economies. And last summer when we were discussing this, it was affecting the global economies. Corporates were really benefiting from it. Now in the States, in the past few months, those figures have started to come off a bit. Just getting a little, so it's past its best. That really hasn't really entered the headlines yet. So it's a slow motion slowdown you're seeing there. And also you'll see something similar in Europe. Obviously UK, we're blinded by Brexit, so that's just filling our minds at the moment. And the Chinese economy is due for a slowdown. So I think we're past the best of the expectation. So my view is people may not be sounding very greedy, but I think they're rather jealous and want to be in there. And I would be saying at the moment, hold back for the moment. If you want to go in, yes, but don't put all your cards on the table right now.
And I think, now I'm not sure if Warren Buffett does watch The Investing Show. I like to think that Warren Buffett watches the Investing Show. But to be fair to Warren Buffett, just in case he is watching, his quote did actually come with a warning about why people shouldn't actually try market timing. And then he had said, although if you are going to try market timing, do the greedy when fearful, fearful when greedy thing. But the problem is, of course, is that whilst it's easy to say don't try and time the market, there are times when people almost have to do that, isn't there? Because they might have a lump sum to invest. If you suddenly have a lump sum that you've had perhaps from an inheritance, you might be someone who's decided that the tax changes on buy-to-let are squeezing you a little bit too hard and you decide to sell up and take your profits from the property market. You might be someone who's discovered that they now have their pension pot that they have to keep invested and draw on for the rest of their life. There are times when you are faced with that problem.
You're going to have to do something.
I've got to do something. What can people do to mitigate the risks?
Well, nothing is not an answer. You have to do something quite right. And the answer is don't make one bet. You split it up and you drip feed into the market. You drip feed into a range of different asset classes and you can just average that out. It's a bit like people saying at the start of the year, what should I do with my currencies for my holiday money? Because you never know. And the answer is buy it in several tranches and you'll get a reasonable average coming out that way. So there's no need to rush. The market's still going to be there this month, next year. So a lump sum, often I'd say to someone, if you've got something like that, take a view of a year to 18 months, and every 4 months or so, then look to actually drip another bit in. In between that, there may be an opportunity when the market suddenly does have a dip, and suddenly there's something that really does look astonishing value, in your rare position when actually you've got cash and suddenly it's at a discount. The trouble is what happens then, everyone then gets frightened. And they don't take advantage of it. But if you are dripping money in and you suddenly do get a dip like that, that's your great advantage. Let's assume that doesn't happen, in which case you just split it up over a year to 18 months, and that way you average out over that period.
And that's the problem, of course, isn't it, Richard, is that a lot of people, when they see that dip, rather than thinking, here's an opportunity to invest some money whilst everything is on sale, they think, all right, I'm holding on to that cash, I'll wait till the market's up a bit, and then they'll buy in actually at a higher price, which is the whole problem with market timing, isn't it?
Yeah, and also bear in mind what you're watching and what you're reading, because there are certain news channels out there which have 24 hours a day to fill, so they are doing the market to death when actually there isn't too much to say. Of course, Justin's absolutely right, you're in it for the long term. And we will continue beating the same drum as well about reinvesting your dividends and benefiting from compound interest. And we've said many times on this show, all of us in fact, that there's always a lot of noise. You can't ignore the noise, but try to look past the noise, because you have to bear in mind that people have headlines to write and pages and hours to fill. Whereas in terms of the simplest essence of investing, of course there are risks. And for first timers, of course it can be daunting. But if you are spread out over asset classes or even over sectors with an ETF, whatever it may be, you are doing that thing of diversifying your risk.
Does this come down to a financial education element, Justin, do you think? I mean, there was a very good column on the back of the FT actually the other weekend suggesting that the great advantage that private investors had over the professional investor is that private investors could just do nothing. and they're often doing nothing, in terms of being invested and then not constantly tinkering with your investments or thinking about whether to buy this or sell that. Sometimes just doing nothing and allowing things to take time to work can be very beneficial, but that's not the message that we normally get as individual investors, is it?
No, you'll always get the message of buy this and sell that. No, actually, and Richard's absolutely right. The long term with compounding, that's the main thing you can do. That's by far the greatest value. But it is interesting because the industry wonderfully over-engineers this to such detail. What else can you invest in? Where's the next big thing? What's the next thing you can buy? Whereas actually, if you just have a reasonably spread portfolio over time, broadly covered around the globe on lots of different asset classes, and let it run, then there's a reasonable chance you're going to get a reasonable to somewhere between 5 and say 6-7%, something like that after costs is very likely to be it. What if you do like to trade, then take a small proportion of that money and stick it on one side and use that for punting. And the definition of punting is very simple. You can afford to lose it. If you can't afford to lose it, don't punt on it. So I like to keep a bit on the side for those very occasional moments when you suddenly do something, see something and say, "Struth, that is cheap." It doesn't happen very often, but when it does, then I can actually take advantage of it. For most private investors, the joy of ignorance. Once you have started, you made a decision to invest, now leave it. Walk away and check it every so often to make sure there are any obvious howlers in there. Otherwise, leave it alone. Put it in a tax wrapper so you get that benefit as well. But otherwise, get yourself a good night's sleep.
And allow those dividends to compound up as well, Richard, isn't it? If you can if you've got shares and you can get an account where the dividends automatically reinvest, or you've got funds and you choose the accumulation option, unless you need to take the income, then over a long period of time, that's something that delivers big returns, isn't it?
Well, that's the beauty of dividends, isn't it? Because if you're an income investor, you look for the stable cash-generating companies where the dividend is covered, so it's probably going to be safe, and there's your income sorted out if you're perhaps a bit older in life. Or you can use the power of the compounding effect for growth in terms of your original investment plus that drip feed that you're getting by reinvesting that dividend. So it's not rocket science, but it's often overlooked, particularly when there's other things going on which may or may not be directly market related, but nonetheless will grab the headlines. And this happens in August as well. General news will move over into financial because there's little else going on.
There's a figure I had in my mind, which is not much in my mind, but this one is. It came out of the old Barclays Equity Gilt study. Yep. Remember that? And it always has there every year £100 invested, I think it was 70 years ago, invested in the equivalent of the UK market, would now give you round about just under £9,000 if you just had the capital value. With the compounding of the dividends, if you'd reinvested those dividends, it wouldn't be £9,000, it would be £189,000. I mean, just on a slight difference, a huge difference. And that's the bit that I think people should learn about and realise, actually, just staying with the story over time and letting it roll up all those regular shares that Richard was talking about that actually pay good dividends on a consistent basis. And even if some of them fail, don't worry, you've got the rest of them, they'll carry on doing it.
And that's why Einstein called compound interest the eighth wonder of the world.
How differently do people need to think if they are in the cohort of people now who find themselves with pension freedom. They find themselves in the fortunate position where they've built up a pension pot, and now they have to invest that pension pot to deliver an income for the rest of their life and potentially protect the capital, potentially, hopefully, they can even grow it, continue to grow it in retirement. But how differently do they have to think to the people who are accumulating through their working careers?
Well, first of all, one thing they must do is tear up those old investment books which told you what to do just 10 or 15 years ago when you retired, because we were always told as you got older, the proportion of your money that was in fixed interest and in government gilts continued up. God knows what happened. You got to over 100, presumably you got to over 100% in gilts.
You became the Bank of England.
That was it.
Just cornered the market.
But of course that now is lethal because gilts, because of what's happened, you've seen the yield come down, the price go up. Now those interest rates are going to go up, albeit slowly. That's going to be a desperately wrong thing to do. Yeah. So the rules have changed in 20, 30 years. So now we've actually got to say to clients, right, now you've got to start on the assumption you're retiring at, say, 65, 70. You've got another 30 years to earn finance, not 5 or 6 years. Therefore, you're going to have to treat the next lot of your life almost as some of the earlier parts. You've got to be in those growth those growth stocks and funds as well, which are going to give you growth and some income, maybe to roll up over that time. Now is not the time to suddenly go into all your defensive things as if you were just going to be retiring now and lasting a few years, because what was defensive 15 or 20 years ago now could be seen to be very risky indeed. The no-risk investments of the 10-year gilt, I'm afraid, is now a risky investment.
So they need to be thinking with a bit of the mindset of the person who is still accumulating wealth. But then they also need to be thinking about what's the sort of natural income that I can get on this and draw, and also should I be spending some of my capital? Because I think what we get a lot from readers when we get asked questions about this is that they'll say, I've got this £100,000 pension pot, I want to draw an income from it, and I want to make sure the £100,000 doesn't get eaten into, which is admirable. And then it'll often come with the kicker of, I'd like to leave it to my children. But then often the answer to that is, this is not money for your children. No. This is money for your retirement. You should be using that money to have an enjoyable retirement rather than living on a shoestring so that you can hand some money to your kids.
And really what people need to think about, and some funds do this, they unitize it. So in effect, you almost blend capital and income together. And if investors can think like that, I've got 30 years to go, I've got my £100,000, and if at the end of it I end up with small change, then I've succeeded. So it is a matter of actually using growth and income over that period of time to give you the sort of return you actually need. If you're just purely basing that return just on income alone, you may be forcing yourself into investments which are paying too high a yield, and if it's too high a yield, the chances are there's something wrong with the business and the dividend's about to get cut or something more desperate will happen to it. Remember, for example, a few years back when Lloyds used to pay more in its dividend than it paid on its deposit account. I think it's probably about the same now.
I think it still does, yeah.
But nonetheless, and it was some of those companies were heading for a fall, not so much the banks those, but other ones where they were paying too much and it was just giving you too many signs of risks. So don't stress about the income. Be prepared to use some of the capital gain as well. You've got a capital gains tax allowance, use that to your benefit, and so spread it out over time. And if your children want to have something, good, that's where you have a grandfather clock, they can have that.
Justin, thank you very much. That's all we've got time for. Richard, thank you very much. Yeah. Thank you very much for watching. Join us next time on The Investing Show. Goodbye.